I'm sure you all know me from social media. My name is Leah, and I was a marriage counselor and intimacy coach for a decade, and I became a trader. I love math. I love trading. I absolutely am obsessed. I've been doing it for 3.5 years now about that. I live in Miami, travel all the time, love traveling, and I'm an investor for almost 20 years. I invest into real estate, startups, of course, my stocks, and I have my passive income streams. So my passive income is my sugar daddy from my dividend stocks and other investments. So I want to do this webinar to show you how I create an extra additional income. And as I said, it's going to be focused on selling options. And before we start, let me just read you a disclaimer. I'm not an investment advisor or tax or financial legal advisor or broker dealer. And by being here, you understand that investing and trading is risky. You can lose all your money. And I'm not here to tell you what to buy, what to trade, or this is not considered to be an investment advice of any sort. This webinar is just for entertainment and educational purposes. All right. So let's get to it, guys, and let's have some fun here. So when I started trading stocks and I signed up at a broker to trade options, a lot of my friends freaked out, and my family and my loved ones like, do not touch options. I'm sure that many of you had the same experience, and you hear horror stories from everywhere, how people lose a lot of money because of options. So I could have just let it be and never looked at options because I would be scared, but I actually was motivated to learn about options even more because they said it's risky. So I was very excited. And I started learning. I started trading options about 5-6 months after I started trading equities, and I learned about them. I learned how beautiful they are. And when I saw the math, I was totally hooked. So, trust me, I made all the mistakes that you can possibly imagine, like many of you. I learned from my mistakes and the hard way because I was just rushing into trading options. I saw everyone on Twitter trading options. I wanted to make a lot of money, 1,000% ROI overnight. So I'm going to talk about some of the risks as well, So I don't day trade options. I don't day trade zero DTs. I don't buy them and sell contracts in the same day. When I trade options, I usually hold the contracts for longer. It's 2 weeks, 3 weeks, up to 1.5 months. When I buy options, I only buy leaps. For example, now I own some Google leaps, Adobe, you name it. I own leaps. Leaps are basically call options that are longer than 1 year. What I do mainly, almost every day, there is some sort of an option contract that I trade. It's usually selling options or spreads or credit debit spreads. In this webinar, I'm going to go really deep into selling covered calls and puts because it's a lot of information and we don't have so much time. And I also don't want to overwhelm you with the information that you get confused, because especially the people, they never traded options. There is a lot of information. So why do I love options? If I buy them, it's mainly for leverage because one leap of Microsoft or Adobe is much cheaper than having 100 shares. And I will get into why very soon, why 100 shares. So again, thanks for being here. Let's get into the details. And I'm going to start right now, show you many real life examples. And I will share my screen with a broker that goes on a paper trading so you can see what I'm doing. All right. So how do you create additional income with options? So again, as I said, many of you own shares in your long-term account. You might have Microsoft, Apple, Nvidia, you name it. You have hundreds of shares sometimes. Many of you maybe got shares through work. You get a comp that you get shares of a company you work for. And sometimes you cannot sell these shares for a long time, but you could potentially trade options on those shares. So I'm going to show you what you can do in this situation. So sometimes stocks are not even moving that much as you wish they would be moving and you're holding them, but you can make extra money by holding these shares. So one thing to remember with options is with stocks, you're mostly looking at where do I think this stock will go? With options, you can also look at where do I think this stock will not go? And that is what I am focusing on when I'm selling covered calls or puts, cash secured puts in this case. So let's get to covered calls, guys. That's the number one I'm going to talk about in very detail. And I'm going to show you the covered calls that I sell and I sold lately. Let me see. Someone is here. Okay, great. So covered calls are one of the most common option trade strategies, and people trade covered calls the most. It's a very simple strategy, nothing to worry about. So let me get into explanation. So basically with the covered call, you lock in 100 of your shares that you own to a contract. You cannot have a collar and a leash and you're bondaged. You cannot sell those shares once you sell covered call on those shares. Okay, you choose a price that you would like to sell the shares for, or you're okay by selling the shares for, and the time when this can happen. What is the upside? You get a premium for the contract that you sell, and you get it immediately. What's the downside? You cannot do anything with the shares. And for example, if you sell $280 contract on certain stock and the stock just suddenly rallies to 300, you will have to sell the shares for 280. So you can totally limit your upside potential. That is a possibility, right? But as I said, I like to look at where the stock might not go and choose the highest probability trade where I feel and think and can estimate that, okay, I think that the stock will not get here in a certain time. But nothing is 100%. In trading, we have only probabilities. You need to always remember that, because you can have all the probabilities in your favor and it still is not going to happen or will happen. So you have to remember that. So when you sell covered call, you will have to provide 100 shares of the stock. You have them. Otherwise, it wouldn't be covered call. You can sell calls without having the shares, but that's called a naked call. And you do not want to do it because that gets really risky. If you're a real pro and you've been doing it for a long time, you can rather do spreads, but I will get into it later, okay? So because you sell the covered call, you get money. You're selling, so you get a credit, you get money for the contract. You are acting as a casino or an insurance broker. And, you know, when you sell the premium and the price of the stock doesn't get to a certain level at a certain time, you keep the premium. If it gets there, you have to sell it, right? So that's pretty much the basics of covered calls and selling of options. You know, statistics show that you have much more chances to succeed. And there's a higher probability that you keep the money when you sell options than when you buy them. That's just statistics. So why I'm always saying 100 shares? One thing you remember, and many of you already know, I have to say it because this is super important for the beginners. One contract of option is always times 100. It's 100 shares. So when you sell a call, you have to come up with 100 shares. You can only sell covered call on 100 shares. If you sell a put, you will have to buy 100 shares. If it's a contract that costs $5, it's going to be real $500 that you get for. So if you see an option change that I'm going to share with you right now, if you see an option chain and there is a price of $30, that's times 100. Okay, so let me share a screen with you because I need to show you all of this in real right here. Okay, so let me go right here. All right, guys, let's look at this. So can you all see my screen? Oh, it's my Zoom. All right, so let's look into this chat. All right, you guys see my screen? Okay, perfect. Let's go. So options are on SPY and QQQ. You can sell contracts every day. We have so-called 0 day to expiry on the indexes. On most of stocks, you have only monthlies, and on highly liquid stocks and mega caps like Meta and Google and you name it, they have weekly options expiration. So you call them weeklies and you call them monthlies. The monthly expires usually every third Friday of the month. So let's look at the chart of Meta, okay? I went back in time on May 26th. You see it up here. This is back trading, pretty much on paper trading on demand. This is Thinkorswim. I use Thinkorswim. I use other brokers, but this one I'm using today to show you. So I look at the Meta chart, and I'm going to show you exactly how I sell covered calls. So I'm holding Meta in my long-term portfolio. All right, and Meta has been rallying. Look how much it's been rallying, a lot. And on May 26th, it's up 2.5%, which is a lot for a stock like this. And it's been rallying a lot. And I look at the chart, and what I see is the gap that we had last year in February is getting filled. I draw my support resistance lines, and I say, okay, there is a huge gap that probably will get filled, but as we know, there will be some sort of a retest, and stock also rallied. You want to be selling covered calls on a strong up day. Please remember it. You're not selling stock on a red day. Never. Sorry, covered calls. You never sell covered calls on the red day. You want to ideally sell after a strong rally on a strong up day, and you want to make sure that you are closer to the resistance, because there is a chance that the stock will retest, right? So I look at this stock, I say, okay, I think it's a day to sell a covered call. So what do? I'm going to trade and look at the options chain, which every broker will have this. And now I look at the option chain, and let me explain to you everything here on the option chain. So here is Meta, it's 259.11. So these are the contracts calls on the left, on the right are puts. Please always make sure you are selling or buying the right option. You want to, this time we're going to do calls, so covered calls on your Meta shares if you own it. So 260 means that is at the money, because it's almost the same price as the stock. So what you want to do when you're selling covered calls, you want to look at the chart, as I said, and say, okay, I think that Meta is not going to get over 280 in next month. Okay, you need to know basics of technical analysis, and this is very simple chart, nothing crazy. You look and you say, okay, there is a gap, 280 sounds plausible, it's not going to get there next month. So you look at the options chain and the strike. Strike means the price that you are okay to sell your shares for, the ones that you own. And you say, okay, if Meta gets to 280 by certain date, I will be okay to sell it there. But I kind of hope it's not going to get there, but there is always a chance. So what do? I personally, and everyone can have different strategies, sell calls usually about 4, 5 to 6 weeks in a time. So in this case, here you see the date. It's 26th of May today on our scenario. And you want to sell about 5 to 6 weeks ahead. So I choose July 7th, which is 42 days. I like it between 30 and 45 days. So we look at the option chain, say, okay, July 7th, 6 weeks from now, I want to look at 280 and 290, because that's kind of the two numbers that I have in my mind. And I look at the option chain. What are you looking at next? Next, very important, you're going to look at bid and ask spread. So bid and ask spread, we all know it from stock trading, but now because you're selling the option, you are the one who is going to be trying to get money. So you will have to put an order closer to the bid. That would be ideal. It's not ideal, but that's what you want to do. So bid and ask spread. Why it's important to look at the bid and ask spread, guys? Because some stocks have a horrible bid and ask spread, especially in options, because they are much less liquid than stocks. So you don't want to trade options on stocks that have giant bid and ask spread, because you have to understand all these numbers you see is times 100. You know, so like 50 cents is $50 that you're going to lose just if you would want to sell that contract, buy and sell in a matter of 5 minutes. I made that mistake before. I would buy 10 calls on a biotech stock, and the bid and ask spread was giant. It was like $200 on a contract that I was losing with the bid and ask spread. And when I realized the mistake that I that was 3 years ago, that I actually purchased 10 contracts instead of one, and I freaked out and I wanted to sell it immediately. I lost $2,000 in 5 minutes, and I was completely sad. And I was like, how could this happen? So make sure with your broker, please, all of you, that you have default settings in place, because my broker, this one, Thinkorswim, had 10 as a default setting. All right. So that's another thing. So pay attention to bid and ask. And here, yes, you want to see volume and open interest as well. So that is better for you to choose. If you see a higher open interest, let's say like 295 would have higher open interest than 290, I would rather go with the higher open interest. So here you can see on this broker, you can choose volume and open interest, bang. And you see, look, 280 seems to be much better than 285 and 290, okay? So, and volume as well. So the 280 seems to be great, you know, but again, it's closer to the price today. So remember, closer to the price today you go, higher the probability that the contract will, you know, that the covered call, that you get called away, pretty much, that the price gets there. It makes sense, right? Because of course it's closer to the price. So, all right, so you look at the open interest and volume, and you see next what you want to look at is the implied volatility, guys, and delta. So let me talk about those two, because they're very important, and a lot of new traders make a huge mistake, especially when it comes to implied volatility. Because what they do, they're buying calls with a super high implied volatility, and even if the stock moves up with price next day or next week, but the implied volatility goes down, they're losing money. And they're like, Leah, how is it possible that the stock price is going up, but I'm losing money on the call? Because of the implied volatility. That's a very important one. If you have really high implied volatility, you see it here on this chain, that means there is a fear in the market and that there is an uncertainty. It's pretty much measure of uncertainty in the market. That's what implied volatility is in short, right? So many traders don't know this. They get really hurt with this. So, but when you're selling options, it's great to have higher implied volatility because that's working in your favor. So, you know, implied volatility is pretty much how much the stock is going to move in 1 year on a standard deviation of 68.2%. So you have to understand the probability, 68.2%, but there is still 32% chance that it's not going to be that case. Okay, nothing is ever 100%. So anyways, so you look at the implied volatility and you want to have high implied volatility when you're selling. So that's great. It's ideal. It's not always going to be, but 30 is decent. Ideally would be 40. Okay, but if it's 30 and really the stock rallied, you get a nice premium. So look at this, 280. You would get about 400 or 390, 395 for that contract. So the implied volatility is 30%. Okay, very important, guys. You know, you want to be selling in high IV environments. It's much better. 40% or 30 is much better than 20. All right, remember that. It's always great for selling options. Another thing you want to look at is delta. So options have Greeks. Okay, they have 4 Greeks. But I don't want to bother you with all of them because it's just too much for you right now. I want to just talk about the delta. And that is important when I'm selling options because that's a criteria I look at. All right. So delta basically means that how much is the option contract price going to change when the stock moves $1. What it also means is a probability that this will happen. So when you look at the delta right here, you see the numbers, and on calls, the delta goes from 0 to 1. So on 280, there is a 26% chance that your shares will get to $280 on July 7th. All right, 26% chance. If it doesn't feel right for you and you feel like, okay, I don't want to really give away my shares, I more want to make money, you want to go to a lower deltas, lower probabilities. So you want to go to 20 or 16. I do not suggest to go below 10 because you really get no premium. Look at this. This is nothing. You don't want to be locking your shares for 6 weeks for $14 or even no, that's not a good idea. Then just rather don't do it. But what you can do here, 16 delta, it's a very low probability. It's 290. You still get about $208, 210 even if you do the medium between bid and ask closer to the bid. And, it's still good money on 100 shares of Meta. Imagine you have 500 shares of Meta, you sell 5 contracts, that's $1,000 for 6 weeks, and if you're holding a lot of shares, like people are accumulating shares, and you can be doing this you can sell every month, every 6 weeks, 20 contracts, you know what I mean? So that way you're creating this income on your shares. But there are rules to remember, as I said. So let me do a quick recap for you, all right? So you sell covered calls on each 100 shares that you own. You want to sell it on a really strong green day or multiple days in a row that were strong and green after the stock rallied. You want to sell it close to a resistance because you want to make sure that the stock might retest and you will be able to keep the premium so you can keep repeating it, right? You want to look at the implied volatility that you can find on every broker here that is higher than ideally 40, but 30 in this case is fine, because remember, the bigger stocks, like for example, also Apple, they're not going to have such a high probability, implied volatility. It's just how they trade. They are like much safer stocks. That's why look at Apple. Like Apple's implied volatility is super low as well, because it's a safe stock. Like Tesla is like casino. Tesla's implied volatility, oh Lord, before in COVID-22, 2021, it was insane that the numbers, look, you see Tesla is much higher because Tesla is much more volatile stock, right, than Apple, for example. So that is important. So then you look at the delta, and I am personally selling below 30 at least. Like I wouldn't sell a stock, a call on my shares more than 30, never, because I want to keep them, right? You want to keep doing this and creating the extra income. So that's what we have, and remember that always. So what are your risks, guys? Your risks are that you will cut yourself short. So I have a horror experience that I learned from selling covered calls. It was on 11th August 2020. I will never forget that day until end of my life, because I own 200 shares of Tesla, and it was the very first month I have been trading options. So I was owning Tesla, and I, for some reason, decided to sell a covered call on a red day. It was a down day on Tesla, and I was on a vacation, and I was speculating, and I sold the covered call. I got like $150 for that covered call on each of my shares. So I made $300. I was like happy. And next 4 days, Tesla, it was a pre-split, rallied so much that in the 4 days until Friday, I cut myself short over $22,000. And I will never forget, I still have goosebumps because I literally was absolutely shocked. And now you might ask yourself, okay, but why didn't you buy it back? Well, yeah, but what happens when the strike price get in the money, when the options get in the money, and you sold the covered call, and then the shares get there, you will have to pay 10x or 15x. Like, I don't even know, I think it was 3,000%. Like I would have to come up with insane amounts of money to buy it back, which would ultimately result in the same loss at the end, right? That's how they are priced. So yeah, I had to sell my shares with a mini tiny win, and $300 I got for the contract, and I was extremely upset. So make sure you never sell covered calls when the stock is starting to rally, when it's getting into phase 2, when it's on a red day. That's not the time to sell covered call, okay? And then again, ask yourself if you're okay to sell it for certain money, because that was a horrible experience. I will never repeat this experience. Even then, like if this happens to you and you don't want to be called away, you can roll the contract. But I tell people, rolling the contract, like let's go back to the Meta, since I was talking about that one. Rolling basically means you will buy back the call and sell different strike, higher strike for a different date. But that is very complex. So I can show you another time, but that is a potential you can do. You might say, okay, on the July 7th, let's go to in time here. We do July 7th where we sold the call. Boom here. Oh no, we're gonna go. So let's go here on the 9th. You can roll, it's like, okay, I will buy back the covered call and I will sell much higher strike, but you have to make sure that you get money for this. And it's not that easy because oftentimes if the stock rallied so much, it's going to cost you a lot of money to buy back the call. And then you will have to sell the other covered call in order to make this money back, maybe even 4 or 5 months in time, because time in options is money. It's theta. It means farther the contract, more money it's going to cost you or more money you're going to get. But again, like then, yeah, you buy back an expensive covered call you're down on and you will have to sell another one so far in the time, 4 months. I don't want to sit on this shares with a covered call for 4 months. And that's me personally. So yeah, bad luck. It happens, really. It happens sometimes. And the other thing, guys, mistake, don't ever sell lower strike than your average price, because that's not covered call anymore, right? That is going to cost you a lot, because if the price of the shares gets to the strike price of the option, a lot of times people sell lower strike than actually the price of the shares they own, because the premiums are great and they want to make some money. Yeah, 42 is great. Yeah, it's a sweet spot. You can do that. Yeah. I'm replying to someone's question. The question is 42 the day to expire a sweet spot? It's good one. Yes. Yeah, that's what I did here too. Between 30 and 45. Again, look at the implied volatility. Look at the deltas, look at, other things. If there are earnings also, be careful with that, because you know what earnings can do. They can rally crazy. Around earnings, I have a strategy that I do. It's called IV crush, which before earnings, when you're selling options, the implied volatility is so high that you get really high premiums, but there is also a huge chance of a big move. So that is also interesting. If you really like on a days before earning, like a literally day of earning or day before earning, you can sell super far away strike on a put or a call, and you get really good premiums. And it's so far away that there is like super low chance of you being called away, right? But because the IV is so huge, you get a really nice premium for that, because there is a fear in the market. So that's another option. And then you buy back the contract next day after earnings, because the IV will be crushed, because the day after earnings, the market or the stock, we know what happened over the earnings and everything is calm after the storm. And then you can just buy back the contract for really cheap or sometimes really like 90% win. So that's another way you can do. You can play with that. Again, be safe. Covered calls. I don't do naked calls. I do only covered calls. I will guys reply the questions after. Okay. I see many questions here. So this is my covered call thing. It's great for IRA accounts, guys, or wherever you can trade tax-free, because you don't pay tax on those contracts. And a lot of times people don't want to sell covered calls because they tell me, if I get called away and I've been holding Meta or Google for years, and now I have to pay the taxes, it doesn't make any sense for me. But guess what? If you're in the Roth IRA or any other tax-free account, 401k, I don't know how you trade those, but you can do this. It's no problem, because you don't pay the tax and you can get called away. You don't care. So what if you get called away and you're really sad that you got called away and you lost your shares? You made some money on the premium of the call. Like, also remember, every time you make the premium, your average price of the shares goes down. Okay, that's another thing. So if you manage to sell every month and a half, a call for $200-300, you're lowering every 100 shares of $2-3 on average. And that's another thing to remember. So that's great. If you do this for a couple of years, you might lower your price of your shares to 0. Who knows, so that's another thing to remember. Okay. You're getting the money, but in reality, you're actually making money on those shares. So another one, if you lose your shares and you're sad, you lost your shares, you want to have your shares back, what you can do, you can sell puts. And let's get to puts, because I love selling puts. I love them even more than covered calls, actually. I love selling cash secured puts. I also, again, puts is the same concept, but it gives you the right to sell your shares for a certain price. So call or covered call, it gives you the right or obligation to sell, but put gives you the right or obligation to buy. When you're buying puts, you do it because you own shares and you are worried, for example, before earnings, you're worried to lose your shares and lose a lot of money on each 100 shares, so you can buy puts. It's a great strategy. It's no problem if it makes sense and you're up a lot. The puts are sometimes $300-400. It's like literally insurance. It's a protection. When you sell puts, you have an obligation to buy shares for a certain price. And each put, again, is 100 shares. So ideally, you have the money to buy. A lot of brokers won't even allow you to sell put if you don't have margin account or if you don't have certain amount of money. You need to check with your broker. But I literally spent the whole entire 2022 with selling puts. And I was even buying the shares for those prices. I got assigned about 25% of times. And I was very happy about it because I was getting into the stocks for the prices that I wanted, and I was getting paid for waiting. Okay, it's great. Again, I had the money to buy because I wanted to buy those shares. I was waiting for those shares. Okay, it gets risky if you don't have the money, and then God forbid the put gets in the money and you have to buy these shares, and then you are having a problem. So that's the risk, okay? Risk with puts, you need to have the money to buy. There was someone who sold, I don't know if it was 500,000 shares of FRC. He was selling puts of $50 each. And imagine what happened with FRC. The stock went to zero or whatever, 30 cents, pink slip. And now this person bought millions of dollars, sold puts, and has to buy millions of dollars worth of puts, worth of FRC shares. So that is a problem, okay? You don't want to go crazy like that. So, you sell as your portfolio can handle, and then you can sleep quietly. But it's an amazing strategy to make extra money. It really, really is great. And when you want to sell puts, so when you're selling put, it's called, you go short put. When you're selling call, it's a short call. So when you want to go short put, okay, yeah, put spreads are great too. I will explain them. I will explain them now too. So let's say I have Adobe example for you. And CRM. I loved selling Adobe last year and CRM and ASML, guys. This puts, you were getting $600-700 per contract. It was absolutely fabulous last year. You want to sell puts when there is a lot of red and blood on the street and red day, exactly opposite of the covered call. You want to be selling puts when the stock is having a hard time, 2, 3, 4 days red, and it's bleeding and it's close to a support, because then it's not going to break through. Most likely it's going to retest, and you can get out of those option contracts earlier too. Same with calls, guys. If you're up 50-60% in a week or two, take your money and run. I wouldn't sit on the contract for too long, right? So let's look at Adobe last year. That was a fabulous selling. You see the chart? So here, of course, I'm not going to pretend I'm the smartest one and I was selling puts on the bottom, but that would be a good timing. Or here, you see on this huge hammer candle on November 4th, right? That would have been a great day to sell puts. And you can go farther. You can go here, even May, here. You can sell puts on May 12th. How beautiful is this, So that's where you want to be selling puts. Even here, look, it retested right to the 10 moving exponential moving average on June 7th. It would be a beautiful day on this huge, massive candle. And you sell put. So where do you sell it? Again, you have to do simple technical analysis. You want to look at the chart and say, okay, here is my support. There is a probability that the stock might get there. You open more moving averages. You want to have 20 moving average 50, and you look at the chart and you say, okay, Adobe fall down to $419 on this day. And if it gets to 380, I'm happy to own the shares. You have to always tell yourself this, even if there is always a chance you will have to come up with $38,000 in this case to buy the shares. So it's no joke, guys. The puts are times 100. You can say, okay, I don't feel comfortable. I don't have 38,000. Let me try 370. That's another level. Okay. And now we go, great, option chain, Adobe. And again, it's June 9th here. So you want to go further in time and you want to be looking at different options times. So let's see, July 21st. Okay, let's look at that. So 1, 2, 3, 4, 5, 6 weeks. It's 42 days. Let me check that one. I want to sell a put 380 or 370 on Adobe. So let's see. 380, the implied volatility is 42%, which is great. It's more than 40. That's what you want to see. Okay. You want to look at the delta. Delta is 9, is nothing. It's less than 10%. So there's like a super small chance that the stock will get there. And you're still getting $277 for the contract, right? So between 277 and 291. So you want to look at this and say, okay, there's only 9% chance, you know, you might even say, okay, let me go then higher, 10%, I get $320 for the put, okay? So you sell the put, okay, you sell it. So you're like, okay, if by July 23rd, the stock gets to 385, I will have to come up with $38,500 minus the 320 I get for the contract. You always distract this, okay? Always remember that's your money. So it's great, but not everyone has $38,000. So for these people, and not just for if you don't have the money, but you don't want to be limiting your buying power on your broker, what you might do is a spread. You might protect yourself just in case, God forbid, something happens to Adobe. You will sell the call and get 324, and then you say, you know what? I will buy, the put, you sell the put, and you tell yourself, I will buy a put just in case, God forbid, something happens with the company, and you buy a 135 or $135, 355 put, for example. That is your risk, right? Your risk now is $30 on a share. So you have to remember that. Spreads are safer. They will help you in the case of complete disaster, catastrophe, and that the stock would just really like fall off the cliff. And they also help you to not be holding, because if it's cash secured put, you will have to have $38,000 in this case, or $38,500 to have on the side in your broker. You will be paying for the margin. So these are all the things that are really great, great to remember. Okay. You can do spreads with everything. Even when you sell covered call, guys, it's another thing to save yourself. You say, you know what? Tesla is crazy stock and I want to sell covered calls on my Tesla shares. I'm getting a sweet premium, but I am really, really going to be upset if something happens. Look how Tesla rallied last couple of weeks. It's crazy. So, you know, Tesla is unpredictable. You might say, when I'm trading stocks like this, like Tesla or something more volatile, I usually do spreads. I was shorting Tesla last year with selling puts, but I always bought a put on a bit lower strike. It's very important because Tesla was falling off a cliff, and it just protects you to sleep better in the night, that you are not that worried about the puts, you're not worried, and you also don't hold too much of your capital, guys. So that's very important to remember. So that's what I do, okay, on stocks like this. So Tesla, let's say you own shares, 100 shares of Tesla, and you own them for $150. You're up nicely, right? You're $100 up on each share. So you say, okay, by July 21st, I don't mind selling Tesla for $300. And look, you get $600 for this call. And it's only Delta 22, $600 for each call. So if you have 200 shares of Tesla, you get $1,200. But what if Tesla rallies so much that it gets to 330? You would be dying. You would be so sad. So what you can do, you can buy higher strike call. Of course, you're going to limit yourself because you get $6 and you're going to pay $3, but it keeps you sleeping better maybe, because you say, okay, well, in the case that Tesla rallies that crazy, I still will have higher strike calls that I can buy as a spread and a protection just in case. So I won't be losing or cutting myself short so much money. All right. Makes sense? You can only trade options when the market is opened. I don't know, each broker there is like some 15-minute limit. You have to check with your broker. Again, every broker is different. A lot of people here are from Europe. That is, again, different story. Everyone has different. So just ask your broker, I think is the best. I never traded option contract after our pre-market or after hours, usually just in the regular trading hours, okay? So yeah, so that are puts. I really enjoy puts. Like now what I did last week, I will show you. CRM had earnings and the earnings weren't too bad. Oh, what happened here? Chart. Okay, so CRM earnings, in my opinion, weren't that bad. But for some reason, the stock first rallied after hours. I will show you on the chart right here, okay? Here. May 31st. So the earnings were there. The stock rallied after hours. I don't even know where it went, like 200 something, 20. And the next morning, look at the gap. It opened and the stock sold off madly. And I like CRM. I have it in my long-term account. I'm trading options around CRM. So on that day, on 1st of June, here, let's go in and back in time. I'm going to show you. So June 1st, we opened. Is it showing me the right? I want to show you bullshit here. No, it's not showing me, sadly. All right, yeah, here, earnings. So you see, it went to $231.50. And in the morning, we opened and bang, the stock was at 206. So I looked at the chart, looked at the daily, and I said, you know what? I don't have my full positions of CRM, and I don't mind to sell some puts. So I did. I looked at the chart, and you see here, that is a nice resistance that now would be a beautiful support. So again, I looked at the chart. Never sell options without looking at the chart, guys. Always look at the chart with everything. Everything you do, look at the chart. Here, that's my support. And I said, you know what? 195 seems like a reasonable strike. I'm going to sell option on, I'm going to sell put 195. So here, trade. And oh my gosh, what is happening here again? Sorry, guys, it's not me in tech. So trade. No, doesn't want to work for me. In any case, you get the idea. I sold 195 puts on CRM. And I was very happy about it. I got $265 for one contract. And just in case, to protect myself, I bought 180 puts. So I created a spread. All right, it was a credit spread at the end. The lower put cost me, I think, was $265, was like $60 or something. So I got $200 for this spread. And I feel safer, I feel protected. Of course, you can lose money. This 180 put you buy 195, you can lose $1,500, okay? But I have that, and I'm happy to have my CRM, and now I'm profitable on the spread. So that's what you can do too, all right? On a bad down day, like CRM, the earnings weren't too bad. It was clear that it was overreaction. If you can read earnings calls, you can do that as well. If the earnings would be horrible, I probably wouldn't sell it right that day, because when the earnings are bad and the sentiment changes, the stock might be falling for 2-3 days or sometimes longer, like you see here. You know, boom. So you don't want that. Then you would wait longer and you would sell the puts at the support, and after 3, 4, 5 bad days, or you know, you see the chart pretty much like here. When you look at these earnings here on March 2nd, then we had 1, 2, 3, 4, 5, 6 days sell off. So this day, March 10th or March 13th, would be a great day to sell puts, and then I would sell them at 158 or 160 or 155, right? You look at the option chain. So that are just examples how I do it, and I love creating this extra income. When you have bigger portfolios, guys, and you hold stuff for a longer term. I have a friend who has 1,000 shares of CRM. So I'm like, why don't you sell calls? It's great income. You can sell 10 calls every month to a month and a half. And again, if you're doing in your retirement account, that's tax-free. You don't care about being called away because you can keep selling the puts. Remember with the puts as well, another strategy I love, I tell myself, okay, I want to buy, let's go back. Let's go to Tesla. Tesla is so fun to trade. You say, okay, for example, you got called away, and if Tesla is going to have a red day, you're going to start selling puts, and you don't care if you get, if you have these shares put, that means you will have to buy them. But imagine, until you get to your price, for example, here, I would say, I want to buy Tesla for $180. And you're going to keep selling puts on red days, because there are always red days. Look, here's the red day on May 25th. There was a red day on May 23rd. Remember, the red day means fear in the market, means uncertainty, means high IV, means bigger premium on a put. So you want to sell the puts, or here you say, you know what, let me sell a put 130 and grab the money. It doesn't get there, okay, but I got $300-400 for this put. A month later, again $300-400, month later, and you might wait 3-4 times and make $1,000-1,500 just waiting, and then you get the shares assigned, which means the price that you get minus the money you got for the puts. So you are having amazing average on the shares, and it's kind of like helping also psychologically. I always love to look at the psychology, and let me just talk about it for 5 minutes, and then we go into questions. The psychology is that a lot of people FOMO into stocks because they want to own them, and they're sad that they're not in Tesla, for example, Meta, you call it. So when you sell a put on a red day, even if you're not assigned the share, or you don't own the shares and you're not assigned yet, it helps with FOMO because you're getting paid for waiting. And it's beautiful because if FOMO is not as strong, you tell yourself, okay, I'm not in the shares, but guess what? Every month I'm making $300, $400, $500, depending on the stock, just selling the put and waiting. And you want to have the shares, so why not waiting? It's great. Exactly. So you can do that, guys, and it helps with the FOMO. And with the covered call, what I love to do now, like we were getting to the top of the channel on SPY, we got to the August highs finally, right? It's wholly $430 something. Let me just get to Friday here. I was selling so many covered calls last couple of weeks, because look at the chart, look at this beauty. We are at the top of the channel, or we are at the top of the massive resistance. And that's a great time to sell calls too, when the index is on the strong resistance, because you kind of estimate that we might have a little retest, which should be healthy. Market doesn't go straight up, and look, we rallied, like we might do a little bit, we might correct a little bit, and it's okay. And it was amazing to sell covered calls. I was selling covered calls on AMD, on all sorts of things, Meta. So Meta, actually, I had to roll because I didn't want to let my shares go. I had a 270 covered calls, sadly, and a couple of days before I rolled it. But with the covered calls, remember, it's always better to wait to the end or day before the contract expiry if you are in the money. If you guys are making money on the contracts that you sold and you're up 50-60%, just buy them back and wait for another opportunity. That's my strategy. I like it more than just waiting. Or if there was a really strong move next 2-3 days or a week after you sold the options, and it's in your favor and you're up in a week 50-60%, take it. Okay, so that's very important. And if you are up on the channel like this, you sell covered calls, and then the market retests, you're gonna not feel that retest as much because your portfolio will be less volatile, because again, you're lowering your delta of the portfolio, right? It's another thing that delta does. So if you own 1,000 stocks and 1,000 shares, and you sell 10 covered calls on different stocks, then the market retest, you can keep all the premiums. It might be $3,000. Of course, it's not going to be the same amount of money as the shares, but look, it helps. Why not? Because if you don't want to sell the shares, you don't want to speculate and say, okay, we're at the top of we got to August highs, now 431 on SPY. Oh my God, maybe we retest. What do I do? You might be a little bit uneasy. You don't want to be selling your options. You don't want to speculate. You don't want to pay the taxes. You can just sell covered calls, and it's going to limit, the pain when the market retests. So that's also another thing how I think about options psychologically. All right. I hope I didn't forget anything. It's just very basic because it's 1 hour. And I studied this stuff for months, and there's always something to learn. And I also suggest you guys take classes on this. You learn, read. There's a lot of great information out there. And practice this stuff, really practice on your paper trading, because it's not only it's complex, but also you can make so many mistakes with little stuff, and there's so many things you have to pay attention to. So you want to practice this on a paper account. And also another thing, you don't have to sell covered calls on all your shares, all right? If you have 1,000 shares or 300 shares, you can sell only one call one day. And you don't have to lock in all your shares. You can sell one call on 100 shares and say, you know what, maybe we go higher. And then in 2-3 days later, I will sell another call, even higher strike. I do it like with everything, PLTR. I have 2,000 shares of this stonk. So like I was selling calls like mad last couple of weeks. Strike of 16, strike of 18, strike of 20, up to strike of 22. And every day I sold 3, and then I sold 4, and I sold 5. Like you don't have to lock in all your share in one day. All right. You can do it day by day. And with puts too, if you want 200 shares, don't sell 2 puts at the same time. Maybe sell one day, and maybe next day will be even better premium. You never know. So play with it. Okay. All right, guys. So let me see. Where is the, oh my God, Q&As. So I'm not part of a trading group. I'm not. I don't have any trading group, sadly, Andy. That's a question. If I'm part of a trading group, I'm not. I have a lot of friends. I'm in a lot of Discords, but I kind of like to trade on my own. And I will let you guys know if I ever come up with something interesting in that realm. I maybe do. I will see. Okay. All right. So let me do this. Okay. I stop sharing the screen now, so you can just see my face, my pink hair, pink light. All right, let me go here. Oh, wow. So you guys asked a lot of questions here. So let me try to go. Yes. Delta is exactly delta. Is delta good approximation of closing in the money? Yes. 10 delta means about 10%, 30 delta, 30%, 50 is 50%. Exactly. That's how it works. That's what delta is besides other things. Delta is also the hedging. You count hedging of your account, but this is very good, guys. As I said, on the option chain, always look at the delta. And if you're selling options that you want to sell the shares, you go higher than below 30 delta means the probability that you will have to, sell the shares is 30% or less. So I go usually 25, that range, 20, 25, sometimes 30 if it's a slower moving stock. Okay. Market coming on. So you guys ask into the Q&A because I see a lot of questions here. Can you buy and sell these calls puts before market opening? I don't think so. I've never done it. I think there is a potential to sell options or trade options like 15 minutes after the closing in some brokers, but you have to check with the brokers, I said. Yes. Do you think you need to make, how big is your portfolio, and do you think you need to make 10K a month with options? I don't think I need to make. I love to make money as much as I can, clearly, like all of us, but I wouldn't take risk in order to make money. I want to make money a rational way. I want to make money safe way. And I want to make it the way that I can sleep. How big is my portfolio? I don't disclose this information, but you can sell calls on any 100 shares. So you can only invest in 100 shares of Tesla, and you can be playing with options with that as well. So that's possible, Where do you suggest to take a course in options and puts for beginners? Shoot me an email, Dominic. You can just reply to me in the email that you got from me, and I will send you some ideas there that you can take courses. All right. So next one. Webull is a bad play. No, Webull is actually a really good platform, though. Webull is beautiful because they are very easy about the rule of $25,000. So you don't have to have that minimum as other brokers. And I think I don't trade with Webull. I don't want to give you wrong information, but I heard from my friends that a lot of them use Webull that it's actually free to trade options, which other brokers, I think you pay $1 for a transaction. Webull is very sweet. Yeah, it's a nice platform. It's also visually very nice. I did day trade it. Miguel, do I day trade options? I day traded options for a year and a half, or maybe even longer. I did, yes. I did. That was all I was doing in 2020, end of 21, and then early 22. Sorry, end of 2020 and 21. Yeah, those years I was day trading options all the time. The issue I had with day trading options is that I wasn't able to limit the risk as fast, because it's especially when you day trade options, you are doing the weeklies. And remember, with options, closer to the expiry, more volatile they are because of the theta. Theta is killing your option contract. And if you're buying it close to expiry, it's going to be moving super fast. It's also much more volatile. So I didn't like the way to manage risk with options. You can set it up, but look, options, you have to pay attention to so many things and dimensions. It's not just like stocks. You have to look at the chart of the stock and then at the option and the delta and all of that. And then I have to set it up in my broker quickly. And I have to set up also the percentage I want to lose. And you get stopped out so fast. I just did not, it wasn't for me. Look, if you can do it, good for you. I did not do well with that. I wasn't losing money, but I wasn't also making a lot of money. So I was like, okay, I make here 500, there I lose 300. I make, and it was just very mediocre for me. So I stopped doing it, and I'm day trading equities only right now. So that's my pretty much, and I'm selling options, as I'm explaining to you, for my long-term portfolios that I create extra money every month. And that works really well for me. So I'm really happy. Do you like to trade covered calls on dividend stocks? You know what? Dividend stocks are usually a very slow pacing, and I don't think that I really, depends. Look, it's difficult to say because Nvidia is also dividend stock, Microsoft is also dividend stock, right? So let's not be hypocritical here, because there are many very, very fast growing dividend stock, dividend stocks. So yes, I do trade them, but when I own just the cash cow sugar daddy, I call it sugar daddy portfolio, where I have only my dividend stocks for passive income. I do not trade options around them, because I don't think you get really good premiums there, though. It's quite frankly, for me to sit for 15-20 minutes, research a stock call and get $15 for that, I don't want to do that work. My hour is $1,000, for example, or whatever you price your hour, what is worth to you. You have to always look at it with trading, right? Like, I'm sitting here for 4 hours and I made $100. Do I want to work for $25 an hour? If yes, great. If no, no. I don't want to spend 15-20 minutes researching a stock and be stuck in a covered call for making $15. So that's how you always look at it. You look at the option chain, you look at that. So mine doing Disney, selling July 21st, 100 call. Let me look for you. Okay, 1 second. I will look for you. All right, so Disney. Great. Selling July 21st, 100 call. What does that mean here? Disney. All right, so the July 100 call is, you get about $60 to $63 for that on July 1st on Disney. And 100, we have the huge gap on Disney from, was it the earnings? Yeah, the earnings gap goes up to 100. Yeah, that could work though. That is, I mean, look, nothing is 100%, but if you sell 100 call on Disney, yes, exactly, Miji, that's it. So if you sell 100 call on Disney for July 21st, you will make about less than 64, because that's the ask. You're going to probably get 62.50 or 60.63, something in that range. Yes. Any good books you recommend for trading psychology? There are so many. Psychology of Money. I love The Reminiscence of Stock Operator. That's a really good one. I mean, it's a story, but honestly, we love learning through stories. Humans love stories, and the way he's explaining how the market psychology works is one of the best books I have ever read, because it's true story of Jesse Livermore being an excellent trader who made millions of dollars and lost it and made it and lost it, and then he basically died really broke. So, right. Another one, Justin, I was curious about how large of a portfolio someone would need to generate 10K a month. Ooh. Okay, that's well, with selling options 10K a month, darling, you probably need millions of dollars in that portfolio, because just when we were looking at the prices, like for example, the Disney stock, a month and a half from now, you get $64 for 100 shares, right? So the stock right now is, you would have to invest $9,200 in 100 shares to get $64 every 6 weeks. So 10,000 a month, it's plausible, but again, it will be a lot, you know, like you probably need, I don't know, it's hard to say. Every stock is different. The time in the market is different. The implied volatility is different. So, you know, if you have a big portfolio, sure, it's possible, but it would be huge. Jesse, do I use option calculator? No, I don't. I don't use it. I don't use it at all, because everything you see and you need to know, and the expecting move and all that stuff is in the option chain, and it's it's all here for me in the broker. So I just use the brokers. They're really good these days. Rob, this was very bad. Okay, yeah, sure, Rob. Just send me an email. I will send you some recommendations. Yeah, I'm sorry if it was too complex. I tried to be I've tried to be very, very, very easy with that, and I hope that it was, at least you learned something that is good for you. And you know, with options, I tell you how it was with me. I literally was gonna cry when I first learned about options, because I didn't understand anything. And I was just learning. It took me a while. So please give it a time, because you learn the theory, then you want to practice. You're going to make some little mistakes. Just always make sure really that the default on your broker is to one contract, especially when you're starting, because that screwed me up the most when I was too fast and I bought 10 or sold 10 contracts instead of one. And you don't want to make the mistakes. Do you get the premium straight away when you sell covered calls, plus the profit when you're in the money? So when you sell the call, yes, you get the profit, but the profit when you're in the money, no, it's only if you execute. And with the contract also, like it shows on your account, but it closes once you're out of that option. So that's how it works. You're gonna see at the end when you close the option, right? You have to open, you sell to open, and you buy to close, and then you're gonna see the real profit. But the money you should get, yeah. Not for the shares, right? You only get money for the shares when the option executes, and that's going to be on the expiry if you don't do anything with that. Not in a day, because remember, the stock is moving. So that you sell a call for July 21st. Let's look at Meta again. Let's say you sell 300 call on Meta for July 21st, and now Meta gets to 300 in end of June. But then it's going to go back down, and it's going to go up, and it's going to go down. So nothing is really happening before the expiry of the option. What you can do, you can buy the option back again, as I said, when you're up 50-60%, you buy it back, and then you realize 50-60% from the option contract, right? I hope it makes sense. All right. All right. So I like to sell credit spreads out in 2 weeks. I do that so I can repeat the process faster instead of going out in a month. Your feedback. Look, it's fine to sell at 2 weeks. I know people, they're selling options in a week because they want to just do it for fast speculation, and it's the way they trade. Look, you can do whatever works for you. I have a different strategy, because again, if you just do 2 weeks, you're not going to get so much money. You get little amount of money, and you know, the options move faster as well, but I don't want to be doing all the work for just a tiny bit of money. So I rather go 30 to 45 days, and then it works. It works for me. This strategy really works, that I get actually valuable amount for my work and for the contract, and it works for me. So that's what I do. TOS, okay. Next time, please trade live. Yeah, well, we would have to do it in the morning. Yeah, TOS analyze step is way better than options calculator. The TOS does amazing job. And you also, which one is amazing, guys? It's Tasty Trades. You can do that one too. That's a really good platform for. That's a very good platform for options. Let me give you a code there, actually, if you guys want. You can open an account there. It's really good, and I love it. I don't think it's completely free, but that one I can give you. 1 second. Tasty Trades. 1 second here. Copy link here, guys. Where's the chat? So I'm going to everyone. So here, this one. This one is great too. Boom. I think that's one. So like in 2022, I think I was up 10% on my portfolio just from selling puts and calls, which is huge. I was very happy with that. So the amount of money I made about 10% on just selling options. That was really nice. I like Theta. Theta is extremely important because closer to the date, Theta, the Greek, my Migos is asking, what do I think about Theta? Theta means the time decay. With options, guys, it goes exponentially. So closer to the expiry you're getting, the option is going to start losing value faster, right? Much faster. So when I'm buying leaps, for example, it's for over a year. Leap is basically a call that's longer than 1 year. When I'm getting 2 months before the expiry, the Theta will start killing me. And that's why when you do these short-term options, you're being murdered by the Theta, basically. If you do the weeklies or the 0DTs, it's just insane because that's how options work. So it's very important to know this. If I am selling call 2 months up front or 6 weeks, I know that like a month before the expiry, the Theta starts working against me. If I'm buying, if I'm selling them, it's actually good for me. That's why I like to sell options more, because I don't have to worry about Theta. Theta is my friend. Okay. So yeah, right on. Start small, learn as you go. Yeah, guys, it's very important, really. Trade one contract, try to sell this week, maybe. Look at the market. Maybe we're not going to have many greens. Who knows? If not, then just be patient. But if you want to buy some shares, like for example, you missed the rally, okay, and you have a FOMO now. So let me share the screen again. Oh my gosh, where is it here? On demand. Let me go to on demand, so I can keep my my stuff discreet. So share a screen with you guys. I, for example, wish I could own more of Meta. I had 300 shares of Meta and I was selling it as Meta was going up. And I'm really sad that I only have 100 shares left, because I was selling it like somewhere here, 200. And I was like, whoa, it went up 100%, let me sell. So I'm sad. So now what I'm going to do, if Meta is going to, where is it? I'm going to see. Oh, okay. If Meta decides to sell off a little bit, I'm going to be selling puts on Meta. I want to get more Meta, for example. So I'm going to be waiting on that stock. And I can't tell you now what strikes and nothing about it, because I don't see the future. But the moment that Meta is having 2 free red days, I'm going to be selling puts on Meta, and I'm going to try to go below this gap, 200, that would be like my ideal. Again, it might not get there. Meta might sell off and get to 240, but then I will be selling puts at 220, 215, 200, So that's my stock I want to add to. If you have other stocks, Apple for me, I don't own any Apple. Imagine, I don't have any Apple. If Apple would have a hard day, which I don't even think is going to happen. I was trying to buy some Apple, but I missed the boat. So I might never buy it, and this is how you can do it, guys. You can just get into your positions by selling puts and getting out of the positions by selling calls. And that's what you do on 10 stocks that you own. And that's what you do all the time. And you can do it in your Roth IRA, and you can only have 300 shares there, and you can do this as well. So it's a great strategy to maximize your income as much as you can. All right. So that was just Apple Meta. Right. What is the biggest loss you have ever made, and how did you recover from it? I lost $66,000 on Baba because I bought 10 leaps instead of 1. And the price of the leap was about 6K. And it was 2.5 years ago. And sadly, I made the same mistake with the 10 instead of 1. And I did not sell them immediately because, again, I would lose like $2,000, $3,000 in the transaction when I realized the mistake. And I would keep them because I was hoping that the market will correct the mistake for me. And of course, what happened? The leaps went to zero. So that's like the most horrible mistake and most costly mistake that I have made. I mean, recover is a hard word because it's lost money. So, you don't recover, you just make the money back, but it sucks. And you guys, if you ever make a mistake, it doesn't matter what you feel. You just get out of the trade. If you make a mistake, you buy more shares, you buy more calls, sell more puts, God forbid, just get out, breathe, and 5 minutes later, reconsider the trade and execute the trade again. Because I can tell you today, I would much rather lose the $3,000 than the 66. And that was the most horrible thing. So are you going to send us a link to watch the recorded session? I will send it to you. Yes, Nigam, I will. How best to do you do with leaps? Leaps are amazing because you have a long time to get to be right, and they're really nice. Like I can tell you my trade that I bought actually. I bought leaps on Google, 95 leaps, I think 3-4 months ago, and the leaps are now up 70% already. So that's really nice, and I'm really happy for that. The leap was $2,000, something like that. They're up, over 60-70%. And if I would want to buy 100 shares of Google for $95, I would have to invest $9,500. This way, I only invested $2,000, and it's a leap for next January 24. So that is a beautiful position. I mean, I'm very happy. So. Have you done webinar on buying leaps? No, I haven't. I could. I'm doing webinars every month, and it's always a different topic. So if you guys have any suggestions, please send me an email. I will be happy to see what you guys think, what you guys are interested in. I'm happy to do another webinar on options. I love options. I love that. So just send me an email. Tell me what you would like to see, what kind of topic. I'm happy to hear some suggestions. You guys all have my email because I will be sending you these recordings. So Microsoft, I love Microsoft. Let's look at Microsoft chart. Let's look at Microsoft chart here. Someone wants to see Microsoft. I love Microsoft. I sold half of my Microsoft position here in my 5-year portfolio. I love Microsoft. I think also we retested a little bit, but we are now sitting below the 10 exponential moving average on daily. So I'm going to wait, and I'm going to see what's going to happen now next week, because again, guys, we are on the top of we're on a strong resistance. And I'm going to wait and see, I wouldn't mind if we go even lower, 322 or 307, if we have a little correction in the market. And look here, this accumulation zone is beautiful. That's a strong resistance around the 305. So I wouldn't mind getting the shares or selling puts around there. Another thing that's really cool with the puts, if you want to really own the shares, you can even sell the same week puts. If you really want to own the shares and you see the stock is having a hard day, you can sell like around at the money put the week expiry, and you get really high premium for that. So you can get the shares minus the price that you get for the put. That's another strategy that's really cool. So if Microsoft goes here 322, it dips a little bit more or even lower, I will be definitely selling puts on Microsoft to get, like, here's a huge gap, earnings gap on 425, 426. So we'll see what happens with the SPY. I mean, I am expecting a little bit of a retest. And remember, we have CPI and FOMC this week. So I'm not going to trade too much on Monday. I'm going to just take it easy. And we have Tuesday, the FOMC on the 13th. And we'll see. We can continue this crazy rally, or we're going to do a little bit of retest. I'm ready for both. I really see what happens. Yay, got lucky with the Apple at last low. Okay, cool. How much money you started to invest? I literally started investing when I was 21, I think. And I just started with $200 a month, very little money at the beginning, $200 a month. and then you adjust it as you go. But you invest really any day is good. And every time you have a little bit money left over, you invest them rather. Every time I want to buy something, like dress, for example, or shoes, I look at the shoes, I look at the dress, and I ask myself, do I really need this shit? No, it's $800 or $400. You know what? Let's buy stocks. It's going to be better for me in the future. Do I really need this? You have to always ask yourself, do I really need this piece? And if not, then instead of spending the money on the piece, send it to your brokerage account and buy SPY or buy some nice stock and own, because that's really what is going to work for you when you sleep. The shoes and the bags and whatever, the phones, and you guys are mostly men, so you probably don't shop like that, but whatever you waste the money on is not going to work in your favor later on. You know, it's much better to have your stocks, and they're going to work for you when you sleep, and you're going to feel it. And as I said, I started investing, I was 21, and I started in little tiny amounts. And then you look in 5 years and you're like, whoa, where does this money come from with the compounding interest? It's amazing. What do I think about leaps on VIX? I don't trade the VIX. I know that FinTwit is obsessed with trading VIX and UVXY and all this stuff. The volatilities is very important to look at it, because also when the VIX is really low, it's the option prices won't be as great. But you know, we are in a very low VIX right now, and people are buying. You know, it's very risky, and you have to really get it right. And the amount of people I know, they lost money trying to trade VIX. I wouldn't do it. Personally, me, I don't. There are so many great things that are less risky you can trade. There is no reason for me to trade VIX, to be honest with you. It's a super speculation. All right, okay. Thanks, guys. Do you follow Fear and Greed Index? I do. You know, I would not sell my long-term things because of fear and greed. What I do with that, again, I'm just selling options on, and I'm adding to the positions, and I sell, like I sold NVIDIA. I love NVIDIA. I was heartbroken, but I just thought it's really overvalued. You know, so I look at that because last year, the fear and greed index was making me a lot of money. Every time the fear and greed index, and when it was extreme fear, when we dipped there 2-3 times in a year, I just went in a lot. And then 3-4 weeks later, I would sell. So that was my way of trading last time. And now we are in the extreme greed. So I'm cautious. And again, it doesn't mean anything, guys. We can be in the extreme greed for a long time. It's same like RSI index. People trade off of RSI. You can be in RSI high, RSI for weeks and months. It doesn't mean anything, but it's good to look at it. Yeah. Okay, last couple of questions and I'm done because my throat started hurting. I talk too much. When you drink a coffee in Starbucks, as instance, do you think you need to own Starbucks stocks at the same time? Do you have this kind of thinking? Some investors use this mechanism. Look, I wouldn't buy stock just because I like it. The company must make financial sense, and the fundamentals have to make financial sense for me. But if the fundamentals make sense for me and I like the product and I'm using it, oh, it's the better, right? Because I love it. But it just doesn't mean that I'm going to buy it because I like the coffee. If they're performing poorly, you know what I mean? So that's a reply to you. And it's also the proximity. A lot of people like to buy stocks because the company is in their town. So, I mean, move to Austin or San Francisco, you would have to buy every stock. You know. All right. Do you buy calls and puts for the day? No, I don't. I don't trade this short-term options trading. I just sell on longer term. Awesome, guys. You guys are great. I hope I didn't skip anyone. If you guys have any questions, send me an email. Please send me your feedback in the email. Tell me what would you like to see next? What kind of topic? I am very well diverse. Can talk about anything, and just let me know. I would appreciate it. And you guys have a wonderful night and enjoy your Sunday, and good luck this week. We all will need it with Daddy Powell. We'll see what he comes up with on us. Okay. All right. Bye, guys. Have a good night. All right. Let me see here. Ciao. Bye.